So I'm going to talk about impact investing, which is investing in for-profit companies for the sake of social impact, with the intention of having social impact. The question is whether it succeeds in meeting that intention. There's two ways you could do impact investing, one being kind of removing your capital from harmful companies, and another being investing capital into socially beneficial companies. How many people here are involved in impact investing? And who would like to sort of get involved? Okay. So yeah, it's getting more attention from philanthropists, and in the kind of for-profit world, there's lots of talk of socially responsible investing. So I think it's worthwhile there being some sort of EA thought about how it might actually do good. So if we look at the history of socially responsible investing, I think it's quite informative. The most visible initial socially responsible investing campaign was the boycott, divest, and sanctions movement against apartheid South Africa. And it's often held up as kind of a successful case of socially responsible investing. But I think if you actually look at the evidence, the divestment campaign didn't have that much effect, and the total funds divested were quite small relative to the kind of size of the funds in South Africa. So it's held up as an example of a success, but it didn't kind of seem to have that much effect. Although it was associated with various restrictive regulations and political pressure being brought against South Africa. In the 90s, there was a lot of attention put towards tobacco divestment, so trying to get investors to take their money out of tobacco companies, and gained quite a bit of attention again, but again, the total amount of funds that were removed from tobacco were quite small relative to the market cap of the industry, so didn't seem to have that much effect. The most recent and most prominent divestment campaign is the fossil fuel divestment campaign. So it's things like 350.org, who are advocating for sovereign wealth funds and pension funds to take their money out of fossil fuels. And this has gained a lot more momentum. And so you can argue it's having a more direct effect on the industry. And you can see here, this is the growth in investing that's calling itself socially responsible. As we'll see, it's a bit of a lot of it's not very strict, so I think some of the labeling is a bit misleading, but nevertheless, there has been quite a bit of growth. And yeah, so this is the proportion that I think is strict of the total stock market. Maybe the assets under management in the world is valued at about 100 trillion, and maybe around 20% of that is socially responsible and strict. So I'll discuss why that is in a bit more detail in a bit. So when we're looking at how impact investing has impact, we need to get clear on the conceptual background. And there's two aspects to this. So when you're an impact investor, you're thinking, how can I actually have an effect on socially beneficial practices in the world? You have to think about additionality, firstly. So you have to think about what difference does my investment actually make to the performance of the company that I'm either divesting from or investing into. Another way you can have impact through your investment is through non-monetary effects. So you might be able to provide non-monetary support to a company that might help it to succeed, and you might have there might be things associated with your investment that allow you to affect the wider world. So like I mentioned with apartheid South Africa, maybe the divestment campaign allowed them to successfully campaign against the apartheid government. The other thing you need to do when you're trying to do impact investing is to find an impactful company, and that is actually harder than a lot of impact investors think it is. So those are the two aspects of how you can have impact as an impact investor. And for both of these, the counterfactual is key. So you can see Gwyneth Paltrow there, just missing the sliding doors getting onto the tube, and you have to think about what would have happened if she'd made it into that tube carriage and met John Hannah, who you can just about see in the carriage. And that's kind of the crucial thing when you're assessing the difference your investment can make is what difference does it make to what would otherwise have happened, and what difference does the company make to what would otherwise have happened. Typical EA wisdom that has been written about impact investing says that in large public stock markets, it's very hard to affect the stock price of traded companies. And the reason for that is that large public stock markets, you have lots of traders who are trying to make money, and they all have the same information, which means that if there's some sort of divestment movement and that causes people to sell their stocks in a fossil fuel company, then socially neutral investors who don't care about impact will just kind of come in and arbitrage away any effect on price. So you can see in this, I'll get the laser to work, there's no laser. But in this diagram, you've got the price falling, and then what happens is that there's reversion to the kind of fundamental value of the stock in the long run, or in the short run, depending on how efficient the market is. So if the market's highly efficient, the demand curve for stocks is perfectly elastic, so it's horizontal. So changes in the demand for the stock don't have any effect on the price. How true is this assumption? How true is it to say that capital markets are efficient? I think there's lots of evidence of short-term efficiency. So on the course of about 3 months, there's lots of evidence that that capital markets are inefficient. You can test this by looking at what happens to the price of stocks that get included in an index. So if a company gets added to the Standard & Poor's 500, that means that lots of index funds like Vanguard are going to come in and buy those stocks, and that's like a short-term effect, short-term increase on demand for that stock. And there is evidence that has an effect on the value of that stock after 3 months. Nevertheless, there is also evidence that the stock reverts to its kind of fundamental value, which is just the net present value of the future cash flows of the business. So basically, stock prices probably revert fully to where they were on the order of 6 months. So if you're running a divestment campaign and you do have a chance of having a short-run effect on the stocks, but they'll eventually revert to where they were. That being said, if no one invested in fossil fuels, then the industry wouldn't exist. So there has to be some tipping point from the point at which, like, you as a marginal investor basically make no difference to the stock price, and where there is an effect, a long-run effect on the performance of the industry. It's a bit unclear when this tipping point occurs. So suppose that 20% of industries in the stock market are harmful, then you might think that in order for there to be an effect on the value of those stocks, you have to 80% of the stock market has to be divested from harmful industries. Otherwise, there'd always be someone to move. There'd always be socially neutral investors to move in and bring the stock price back to where it was. I think this is unrealistic for various reasons, namely that there's kind of constraints on how far traders can move into different markets, and other things. So it makes it not realistic. Maybe the lower tipping point is that divestment campaigns will start having an effect when the divested funds, the size of the total divested funds is comparable to the market cap of the industry. So if fossil fuels are 20% of the industry and 20% of the stock market is divested from fossil fuels, then that will start having an appreciable long-term effect on the stock price of those companies. Maybe it's something in between. So I think there's more research on this would be useful, but to get further into this question, we need to understand how much of the stock market would be good, how much of the stock market is good and bad, and how much socially responsible investing is there, like how far away from any potential tipping point are we? So about 20% of, like 20 to 30% of the stock market is in, this is like fossil fuels. So you might think that, so you might think that, you've got to add in like tobacco and alcohol and prostitution. Well, they're not going to be traded on the stock market, but tobacco and alcohol, things like that. So that's how much of the stock market is harmful. And then this is how much SRI there is. This is socially responsible investing. And it's kind of, I think it's important to point out that a lot of socially responsible investing isn't very strict. The strictest form is the bar chart at the bottom, which is negative or exclusionary screening. And what that means is you exclude an entire industry from your fund. So you exclude fossil fuels, for example. And then you kind of, as you go up this chart, you get kind of less and less strict. ESG integration just means you take account of environmental, social governance scores of different companies, and that is often not very strict. And then there's like less important things further up. So, yeah. So best in class, which you see is third top there, like quite a small part of socially responsible investing. Best in class just means you're the best environmental, social governance company in your industry. So if you're the most environmentally friendly tobacco company, that can mean you get a best in class score. And as ESG ratings are done at the moment, they're not a good guide to social impact. So you can see here, this is from Yahoo Finance, you can see the ESG ratings for British American Tobacco and Lindt, the master chocolatiers. And the ESG rating for Lindt is actually lower than the one for British American Tobacco. So something's going wrong with these rankings, basically. And then that leads to certain funds that label themselves as socially responsible, including think companies like ExxonMobil. So this is Vanguard's socially responsible investing fund, includes ExxonMobil, and that's quite a common thing. There's a lot of mislabeling. It's quite misleading. And also I think it's like worth mentioning some socially responsible investing funds exclude nuclear power, even though I think nuclear power is like good for the world. So where are we in relation to the tipping point? So I think about 20% of socially responsible investing is strict and socially responsible, and maybe like 20. So there's 20 to 30% of the fossil fuel. 20% of the stock market is in fossil fuels, and then so we might be nearing the tipping point at the moment. And I think the value of the oil and gas industry is upwards of $4 trillion, but according to 350.org, about 11 trillion has been divested from the fossil fuel industry. So you might expect this to start having a material impact on the stock prices of these companies. Another point that's often made is that in large public stock markets, you're dealing with equity in secondary markets, which means that it doesn't really affect the activities of a company that whose stock is traded there. It just affects their shareholders, not their usable capital. So if you're a big tobacco company, you're going to get a lot of your income just from selling all your cigarettes, rather than raising finance from investors. And it would only affect you if you wanted to raise extra capital by selling additional stock. But nevertheless, there's reasons for these companies to care about their stock price, namely that shareholders care about having money, so they're going to put pressure on the company to change if they can. And it's also going to be important for new and growing businesses. So if there's a startup cigarette company, it's going to be harder if lots of investors have divested from them, and everyone knows that. But I think this point is generally less important. Another key thing to think about if you're doing socially responsible investing on the stock market is whether you lose out financially. Because if you lose out, then the opportunity cost is money that you could have donated to something effective. The reason for thinking that there's financial sacrifice is just that you're arbitrarily foreclosing part of the stock market, and any rational investor would just want as many options as possible. So according to modern portfolio theory, you just want as big a portfolio as possible. That's going to reduce your risk. The argument against that is that maybe ESG ratings are correlated with financial performance for other reasons. So maybe fossil fuel companies are going to face additional litigation, additional regulation, consumer boycotts, and things like that in the future. And also, I've forgotten what I was going to say. But anyway, so there's theoretical reasons there. And then the empirical evidence is kind of mixed, as you might expect. It's going to be very noisy. You're looking at the performance of, SRI funds and just standard investment funds, and there's lots of different things going on, and it's hard to kind of tease out all the different confounders. So the meta-analyses that there are show not much of an effect of SRI on financial performance, if any. And the theory says that the benefits to kind of diversifying across the whole stock market are actually quite small. If you own 50 stocks, you get like 90% of the diversification benefits that you would have if you had access to everything. So it's pretty modest. There's also evidence that sin stock funds, so funds that just buy things like tobacco and alcohol and gambling, consistently outperform the market. But again, it's hard to say why this is. It might be because they face high risk of litigation, so there's additional risk and that kind of thing. So I think it's reasonable to think that if your socially responsible investing campaign and program gets close enough to a tipping point that you could at best have at most a kind of modest effect on the stock price of the targeted companies, but that you probably don't have to sacrifice that much financially if you do that. But the existing evidence is very noisy on that. So maybe SRI is better than socially neutral investing from an impact point of view. But that doesn't mean that you should do socially responsible investing instead of effective donating. I think the total amount of the effect you can have is quite small. Where you could have greater impact is in inefficient markets. So where there's fewer traders and there's imperfect information. So things like venture capital and angel investing. If there's only a very small number of investors that know about the opportunity, that means there's just less opportunity for people to move in, and this kind of counterfactual effect is not as big as it might appear. Nevertheless, I think you still need to think about these counterfactual considerations. So you need to think about additionality and what difference your investment could make. And a lot of impact investors don't really do that. They just think about, what did the company do? I invested in it. That's good. But you need to think about what would have happened if I had invested. There's also some evidence that divestment campaigns have been correlated with restrictive regulation of harmful industries. But I think it would be surprising if that turned out to be the most effective way to target an industry. It's something we started for other reasons, and then we're saying, oh, it's actually good because it raises awareness. I think there's probably better ways to raise awareness. I think that's more likely. So that's additionality, how you have additionality as an investor. Then you need to think about, how do I find an impactful business? And I think something that a lot of impact investors don't take account of is that calculating profit is very different to calculating social impact. So with profit, all that matters is, did I win or not? Whereas with counterfactual social impact, what matters is, what would someone else have done? What would this other business have done? So if I'm Facebook, I need to think, what would have happened if a different social network would have taken control of the market rather than me? And it might be that I actually do harm, even though lots of people are happy to pay money for my services, if the thing that would have arisen instead of Facebook was better than Facebook. Just because you take over the market doesn't mean that you're having lots of counterfactual social impact. And finding impactful companies is very difficult, and I think that's often neglected in the impact investing space from what I've seen. And it's not just about casually totting up social KPIs and doing fairly casual impact analysis. If you compare it to what organizations like GiveWell do, they're putting hundreds of hours in every year into evaluating charities and being very rigorous about it. Overall, like, optimizing for impact is hard, optimizing for profit is hard, so optimizing for both is very hard. And as we've seen, ESG ratings aren't much of a guide if you want to do it in public stock markets. So I think the best conditions to find impactful companies are that have enterprise impact is finding companies that produce positive externalities, serve very poor consumers, or provide products that are undervalued by consumers. And if you think about companies that provide products to consumers who are very well off, something like Amazon, Uber, people like that, they've got high willingness to pay, and so the social value that those companies provide is reflected in the share price. That's not always true, because companies like Impossible Burger, Beyond Meat, companies like that have externalities for animals. So by reducing meat consumption, they reduce animal suffering, and that's a kind of benefit that's not captured in the transaction. And that's a way a company can have impact that's not commensurate with its market value, and the same for Tesla, arguably. The other thing is serving poor consumers. So that means serving the very poorest consumers in the world, because there's diminishing marginal utility to money. So there's greater consumer value from serving the poorest consumers in the world versus people in the US. You can see here life satisfaction plotted against income. It's much better to improve consumer welfare in India than it is to improve consumer welfare in the United States, because people in the United States are much better off. And yeah, also providing undervalued products could be a way that you provide social value in a way that isn't reflected in the value of your company, so maybe providing CBT or something like that. So in conclusion, the best kind of impact investing, I think, or the kind of impact investing that stands the greatest chance of impact, involves doing venture capital or angel investing. It involves investing in companies on the brink of financial viability, where your funding would actually make a genuine difference to the survival of the company. And the company produces positive externalities, serves poor consumers, or provides undervalued products. Those are the sorts of the principles, I think, of high impact investing. So then this big question, I suppose, that's relevant for effective altruists is, how does impact investing compare to donating? And this is a question that philanthropists are asking themselves, and obviously there's like a lot of stake on in this decision. It's hard to make any general claims about this, because I think it depends on the concrete cases. So I can imagine there being cases where impact investing is better than donating, but I can also imagine cases the other way around. So the general advantages of non-profits are that they can provide public goods. So public goods are sort of archetypally something that can't be provided by for-profit companies, or where the market mechanism isn't set up in the right way. So that's a picture of Hilary Graves, who does research at the Global Priorities Institute. So this is like producing the public good of kind of knowledge about how to make global prioritization decisions. There's no private incentives for anyone to do that. Another advantage of non-profits is that they can provide goods to the very badly off, where there's just no market viability. So there's famous studies of, if you charge people for bed nets, the demand just goes to zero, and if you give them away, people use them. So there doesn't seem to be a case in this particular instance for providing that with a for-profit. And non-profits are kind of reliably more neglected because there's no profit involved. So that's a reason to think that's one reason in favor of non-profits. The main advantage of for-profits is they're not subject to a principal agent problem. So this is the play pump. I don't know whether you've heard of it, but it actually looks good there, but didn't go very well. And the reason is that the people that the project was trying to serve were not the people who paid for the project. The people who paid for the project were the donors to the project. So that means that you don't get this consumer feedback that you get if you're a for-profit business. And I think it depends on the cause. So in the animals case, I can see it being true that 30 years ago it would have been actually better if a lot of the animal advocacy money had gone into meat alternatives research, and that I could see that plausibly would have been better than going into non-profits, like trying to create for-profit companies like Quorn or Impossible Foods or Beyond Burger. I can see the case of that being higher impact. So that's an interesting kind of test case of a situation where SRI, socially responsible investing, might be better than donating. I think it's probably not true anymore just because it seems like a very crowded space and it's hard to find unfunded opportunities. In global poverty, you can fund things like remittance companies, but again, you need to consider additionality, whether socially responsible investors would invest anyway if you didn't do so. It's hard to say anything very general there again. I would say that I think like the general standard of impact evaluation by socially responsible investors is not that high at the moment, so there's reason to be cautious. In long-termism, finally, so there's climate. You can do lots of stuff in climate. You can fund kind of clean energy providers or electric cars, things like that. You could also fund biorisk stuff, but it also seems like a lot of the best things are kind of public goods that it's hard for the market to provide. And yeah, I should stop there. So thanks very much.
All right, cool. Just a short window here for questions. We're already just about at the end of our time. An interesting one that's kind of not covered, you covered a lot of ground and I think covered most of the questions that have come in, including most of the ones I jotted down along the way. But one that was not covered in your talk is, what do you think about the possibility of doing more sort of local social impact investing, such as one person suggests becoming a landlord in potentially a community that's underserved or where you think you could make an impact and have some additionality?
I'd be surprised if that was better than like the best thing in global development or something like that. So yeah, just for the usual reasons would be my reaction.
The usual reasons being?
Being that people here are much better off. So yeah, it's like less value in providing consumer value there.
I was surprised to see that 20 trillion out of $100 trillion are marked strictly socially responsible. Mm-hmm. You covered some problems with that, but just to make sure I even have that correct, and the audience does too, that's basically people that are like excluding tobacco, and that's more or less it? Or how?
Yeah, I think so. It's hard to get particularly good data on it, but yeah, it's going to be excluding specific industries. Some of them might have done it for selfish reasons and like gone, I can see the way things are going for the tobacco industry, it's just going to be legislated out of existence. Now we're doing socially responsible investing. But yeah, that seems to be the portion of socially responsible investing that is strict. So yeah.
Do you have a sense for how much of the impact? It seems like overall you're kind of bearish on the concept of impact investing. I mean, there was kind of a little bit more hopeful tone around early stage VC, and otherwise not so positive. But do you think that there is something to be said for kind of taking a concrete stand and making a statement about money that kind of goes beyond speech and is, in a sense, more effective advocacy or more effective speech because there's money behind it, even if ultimately, the stock price reverts to the mean, as you said?
Maybe. I would still think that just funding advocacy directly and thinking about what's the best way to make this point through other kinds of funding would be the best way to do it, rather than through this very circuitous thing where you say this is actually having a material effect on the bottom line of these companies when it, unless something big happens, it's not doing that. Like I still think there might be room for cases where socially responsible investing is good, but yeah.
So one last question, and I'm hearing my sophomore year economics professor ask it as well as one of the audience members. It seems like ultimately where you'd come down on this is invest for profit and then donate your profits. And that seems to be, aside from pretty limited cases, the recommendation that you would make?
I wouldn't say like definitely do that. I think it's still a bit unclear. There might be cases where impact investing is a good thing to do. Someone actually needs to sit down and figure it out. So I wouldn't want to say definitively either way. Yeah, I think this talk is more just kind of laying out the conditions. When could impact investing be good? And allowing us to think about how would we go about assessing whether it could be better than donating. I think it's still kind of an open question. I know there's a few people who are doing work on that question, and I think it needs a bit more attention.
Alrighty. Well, you can potentially get some more attention on these questions in office hours immediately following this talk, correct?
Yes, absolutely.
All right, awesome. Well, how about a final round of applause for John Halstead? Thank you very much. Great job.